All right, so we are live on YouTube as well now. We have about over 20 participants in the Zoom session, and more people are joining in from YouTube live as well. Welcome, everybody. My name is Ankit Kejriwal. I'm a senior analyst at SD Advisors, and I welcome all of you to this exclusive session where we are going to be discussing what it takes to retire right. Now, Vivek, we were discussing yesterday like how retirement planning is one of the most difficult problems to solve, and it's often very challenging for people to grapple. So, in this session, what we are going to do is we are going to break down complex problems into simple solution and gives you the math behind what it takes to retire right. Vivek is the investment head at ST Advisors. He has been with ST Advisors for over 7 years and has over a decade of experience in trading and investment management. He is a BTech and MTech from IIT Kharagpur, and he's going to be taking you through this session. Welcome, Vivek.
Thank you, Ankit. Thank you, and I welcome everyone here who has joined us on a Saturday to learn about retirement planning.
It's not the most exciting subject, but it's the most important subject. Would you agree, Vivek?
Yeah, definitely not the most exciting one, and that's where the I think the problem also lies because it's not most exciting. People tend to delay it for far too longer.
Let's begin, Vivek, whenever you are ready.
Okay, I'm ready. Let's dive in. Okay. So, like we were talking about right now, that it's definitely not one of the most exciting subjects to talk about, to learn about, and that's why we see a lot of people who really don't have a retirement plan. And if you look at this data, you'd see most of the people are really without the retirement plan. Maybe 15, 20 years back, it would have been just fine because people traditionally relied on their children for financial support and we were all mostly living in joint families. Now, this specific shift from joint to nuclear families and also from government sector to private sector, and even in private sector, we see a lot of employment in the informal sector rather than the formal sector. And because of all of these reasons, I think retirement planning becomes a very, very important subject, and not only a subject, but something that we should all, after a point, definitely plan our retirement well, right? And what happens if we really don't plan? I think one is obviously the forced employment. You are actually compelled to work much longer than you want to, or much longer than maybe your health allows you to, right? So you sacrifice not only your health, your time, but also peace of mind in those golden years. Secondly, you might be depending on your family, on your children, or your relatives for these financial needs, obviously creating unnecessary stress, and obviously in the later parts of the life, it definitely does affect your dignity and self-worth if you are relying on someone else for your financial dependence. Right. So definitely retirement planning is crucial, very important for everyone to plan. So here today, what we are going to talk about is how much money you need. I think that is one of the biggest topics, that how much money you need, how to invest for it, and how much you can withdraw. So, so we'll also share a specific Excel in which you can put down these numbers and find out how much you need to save, how much you can afford to withdraw. So we are going to talk about these terms like safe withdrawal rate, the 4% rule, which tells you how much you can actually withdraw. But this 4% rule is also, does it work in India? Because I'm sure many of you would have heard the 4% rule. We are obviously going to talk about, if you haven't heard, we are going to talk about what this 4% rule is, does it really work in the Indian context? So we are going to talk about the safe withdrawal rate for the Indian context, and also then talk about the practical retirement planning strategies for longer term success. So let's begin with safe withdrawal rate. Now, this is the first step you need to look into when you're starting your retirement planning. First step is obviously how much you need to save, and before that, what we need to learn about is the safe withdrawal rate, how much you can actually withdraw, right? Because your requirement also depends on what you want to withdraw, right? So safe withdrawal rate is the maximum rate that you can withdraw from your retirement portfolio without risking its premature depletion. The time frame here is taken to be 30-year period. So for example, let's say you have a 5 crore worth of portfolio at the time of your retirement when you're retired. So if let's say your safe withdrawal rate is 4%, which means that you can withdraw 4% safely from your retirement corpus without risking its premature depletion. So what you want is definitely you want your retirement portfolio to last at least about 30 years or so. So if you retire at, let's say, 55 or 60 up until 85 or 90, that retirement corpus should last. That is one big thing, and it should last with a certainly high probability levels, right? So 4% rule comes from there. So if you are withdrawing 4% from a 5 crore portfolio, that becomes 20 lakh. But I think the one of the biggest confusion here is people think that they can keep withdrawing 4% every year. That's not what 4% rule states. It states that in the next year, you just have to adjust for inflation. You don't have to again withdraw 4%. You just start 4%, which is 20 lakhs from a 5 crore portfolio. But in the next year, you actually just adjust it for inflation, which means if the inflation, let's say, is 6%, you bump up this 20 lakhs by 6%, which gives you 21.2. And that's you keep on doing that. If the inflation is 9%, 10%, or it might be 2, 3%, you just adjust whatever you need, whatever you have withdrawn last year, you just adjust it with the inflation and you get your money that you can withdraw from your portfolio. Right. So that's how the 4% rule works. Talking a bit more about it, it was, I think, suggested by Mr. Benjamin, who was a retirement planner, a financial advisor in US. And this study was done, I think, in 1994 or 96, somewhere around that time. Here, the assumption is that your retirement horizon is about 30 years. Your equity is a decent equity, but not too high, about 50 to 70%, and the rest in bonds, right? It is very, very popular method, 4% rule. It's widely cited on social media, on blogs, and it's one of the key retirement planning tool that people use to find out how much they can actually, how much they'll need. Longevity, we have already spoken about 30 year, and the main point here is, does it work in the Indian context? That is something that we are going to talk about here. So why the 4% rule actually does not work in Indian context? First of all, it's the wrong economic context because 4% rule came from the US market conditions where they have taken into account the returns from US equity markets and also the returns from US bond markets, and also the inflation numbers, right? For India, we all know that all of these numbers are definitely quite different. One is definitely inflation because India has, although in the last 1 year or so our inflation is down considerably, but over longer run, India has a much higher inflation rate as compared to US, and that's why this specific rule of 4% becomes really unreliable for Indian investors. So what rule works? So by the way, how do you use that 4% rule? So the 4% rule is, let's say your total portfolio, currently you are withdrawing, let's say, uh, 10 lakhs for the year. That is what your current requirement is. At the time of retirement, if somebody is retiring right now and he or she wishes to withdraw 10 lakh per year from now on. So the portfolio needed for that specific 10 lakh number would be, you divide that 10 lakh by 4%, right? That's what you are withdrawing. So if you divide that 10 lakh by 4%, it gives you about, uh, I think, 2.5 crores. So that is your number. That is how you arrive at the retirement corpus, whatever you need in order to withdraw that 10 lakh. If that number is 20 lakh or whatever that number is, right now your annual expenses you divide it by 4% and you get whatever corpus you need. So in the Indian context, as per the research done by Indian researchers, this number of 4% is actually very, very high. You won't be able to keep withdrawing 4% and still last those 30 years. The probability of you running out your corpus becomes very high. So in the Indian context, this number is somewhere between 2.5 and 3.5%. Right. So if you want to take a very conservative view, then this number becomes about 2.6%, which means what you will need is 40 times your annual expenses. So this same, taking that same example of 10 lakh, if you were to just withdraw 2.6%, then in that case you need 4 crores instead of 2.5 crores that we spoke about. If it is 3x, 3% you are taking, then it is about 3.5 crores. Or if it is you're really aggressive and want to withdraw more, somewhere around maybe 3.5%, then even then you'll still need more than 2.5 crores. In this case, in the aggressive case, your requirement would be about 3 crores or so. Right. So that's how you calculate your required retirement corpus from the annual expenses and also from the safe withdrawal rate you actually want to use. Right. Or the other way around could be whatever money you have at the time of retirement, what is it that you can withdraw? And you can withdraw maybe about 3%. So you have, if you have saved, let's say 3 crores, in that case, 3% of that 3 crore is about 9 lakh. You can afford to withdraw 9 lakh and then adjust for inflation every year. So yeah, so this number is about a 1% lower in the Indian context. Now let's talk about sequence of return risk, because one of the point here was also equity, that how much equity you should have. And to understand how much equity you should have, we first need to understand the specific risk of sequence of return, which means your return series. So we have one return series here, which is minus 10%, 20, 15, 12, and 25. This is one return series. Now, does the order matter? Now, let's see if the order matters or not. So, when you are investing and you are not doing any withdrawals or any deposit, at that time, if you have a bad early start, which is first year is minus 10% and then it is higher, then your returns are higher. In that case, you're starting with 100, you end up at 174, right? But in case you have a bad year later, which is in the fifth year, right? So rest overall returns are same, but only the order is changed here. Now 10% has become is coming in the your final year. In that case also, your final retirement corpus is exactly same. So here what you're seeing is, if you're not withdrawing, if you're not depositing, the sequence of return really does not have any impact on your portfolio. Now let's consider another case of deposits. So this is when you are actually saving for your retirement. Then what happens? If you have a bad early start, in that case, your corpus becomes 198. Whereas if you have a bad later start, in that case, your corpus becomes 192. Now this is quite interesting, because if you have a bad start, many times we actually get quite anxious that we are saving for some specific goal and we are having a bad start. But what actually happens, if the bad start happens at the early stage, you are able to invest at lower levels, which means you get more units or more shares, right? So actually it helps you. If you have a bad start, it really is helping you. Obviously here the assumption is that the series remains the same. So if we assume that overall longer run equities are going to give you about 12%, whenever those bear markets happen, it's a very good time if you are in that saving mode. Okay. Now let's have a look at what happens when you actually start withdrawing. So when you start withdrawing, in that case, what is happening is, again, that same series, bad early, which is first year, you have a minus 10%. You withdraw, right? And when the market is coming back, it's coming back with lower corpus. right? And that's why you end up at 149, which is lower than the case where the ending is really bad. So this is the sequence of return risk. In case of withdrawals, if early in your retirement you have a bad start, which means equity is correct early, then that is one very big risk for you, right? So the average annual returns in both these portfolios were 12%, but depending on whether you are depositing or withdrawing, it can have a huge impact on your overall portfolio. And this we have just shown for 5 years. Imagine this extrapolated to about 30 years, which is the usual length of your retirement, right? So what is happening here is in the earlier case, let's assume if your withdrawal rate is 4%, then your failure rate is about 25%, right? But in the normal scenario, but if you have a 10% market shock in the first year itself, then your failure rate actually increases to 75% from 25%. And this is the biggest risk if you have a, a black swan event or a specific bad early start, and which is just purely on luck. You really cannot control. One way to maybe control is you you retire after the bear markets, but again, even then it is very very hard. It's like you're trying to predict the market, so it's really very hard for you to control or to pick when exactly to retire. So this is a risk which is always going to be there for you. Can you just give me a moment? There's some noise here. Just
In the meanwhile, people, if you guys have any questions that you would like Vivek to answer, you can start dropping them down in the comment section, and I'll make sure to answer to ask those questions to Vivek. Yeah, Vivek, please continue.
yeah. Okay. So now let's just come to how do we calculate what is really required in terms of savings to reach your retirement corpus. So let's take this example that your current monthly expenses are about 1.5 lakhs, and let's say your current retirement corpus is say 2.5 crores. Right. This is what you have already saved. Your current age is 45, 44. You are planning to retire at 55. So your years to retirement are 11 years. And these are the assumptions on returns and inflation rate. You're assuming 10% return on your portfolio, 6% inflation rate, and in this case, you're assuming 4%, which, as we have seen, that 4% is on the higher side. It's pretty aggressive for Indian case, but this is just for the example. So your future value of existing corpus at the time of retirement, which is 11 years from now, would be about 7 crores. This 2.5 crores will actually grow to just above 7 crores with a rate of return of 10%. Your monthly expenses, which is currently 1.5 lakhs, you adjust it to inflation of 6% in 11 years. This is going to be monthly expenses of 2.8 lakhs. So your retirement corpus required would be about 8.5 crores. Now, in this specific case, obviously, you can see that he has done a very good job of saving substantial amount. Uh, so in this case, what is the monthly SIP required is just about 60,000 or so, right? So I'll just quickly stop here and share another sheet, which is the Excel sheet, which I will be sharing with you after this. One sec. Okay, Ankit, I've shared the Excel file. Can you let me know if you can see the Excel now?
Yes, Vivek, it's visible.
Okay, so this is an Excel we have created. It's quite simple. You can just input. These are the input numbers. Let's say your current monthly expenses are 1 lakh. At 40 lakhs is the current retirement corpus. 12% returns. Current age is, let's say, you take 35, retirement age is 60. So in this case, what is required is for you to save about 32,000 per month from now on to actually reach the required current corpus, assuming a safe withdrawal rate of 0.4%. If this were to you were to take it at 3.5%, then you actually your SIP requirement moves up from 35,000 to about 42,000. So this is one sheet that you can use to actually calculate how much of retirement corpus you will need and how exactly to reach there. Right. Okay. So now let's talk a bit about how can we actually optimize this thing, because at 30x or 40x, it's quite a large amount of money. Can anything be done to really reduce your requirement so as to maybe retire a bit early, or you are able to withdraw slightly higher amount? What can be done? What tweaks we can make in order to achieve these goals, right? So one of the things that we have currently assumed is we have assumed a fixed spending, right? Fixed spending means obviously it's changing by inflation, but it is purely fixed. And obviously, uh, many a times we do have flexibility. Our expenses also change, but many times we do have the flexibility also to at least tweak our expenses on a year to year basis. At least we have some leeway there. Most of us, I am assuming, would definitely have. Um, Second is it also ignores this specific solution of one fixed rule, whether it's 3% or 4%. It ignores market conditions. What if the equity markets have run up wildly in the first 5, 10 years, or we had a bear market in the first 5 years, right? And can be too conservative in good markets, or it can be too risky in the bad ones. So, what exactly are the adjustments you can make in your withdrawal? So, there's this concept by the name of dynamic withdrawal rate. What you do in dynamic withdrawal rate is, if your investments are doing well, which means if equity markets are doing well, you are able to withdraw a bit more, allowing for increased spending. And if the investments are struggling, if there is a bear market and maybe an elongated bear market, then you would actually need to reduce your withdrawals also to help your the overall corpus last longer, right? Now, what are these? Let's get into a bit more specific about what these dynamic withdrawal rates are. What kind of dynamic withdrawal rates you can use, and how does this help us really? So there's one technique known as inflation forgo, and as the name suggests, you what happens is, in a negative year. So if your portfolio is down, which is primarily going to happen from equities only, the fixed return component is much more stable. So if overall the markets are down and your portfolio is down, you had a negative year, then next year what you do is you just have to do away with inflation. You don't step up your withdrawals. So let's say last year you withdraw 10 lakh. Next year, even if the inflation is 6%, 7%, whatever that number is, you withdraw that same amount of 10 lakhs in the next year. That's the thing you have got to do. Um, so that's the only change that is required in this. It really helps you in preserving your portfolio and making it last longer, right? And we are going to see that numbers also. And the second approach is that of guardrails. Now, guardrails, what happens in guardrails approach is you use specific guardrails, the up and down guardrails. In that, what happens is, if the portfolio is falling, and you have this buffer of 20%. So in case your initial withdrawal rate is 4%, you do 4% plus 20%, which is you coming at the top guardrail of 5%, and you do 4% minus 20% of that 4%, which is 3%. So that 3 to 5% becomes your band. So what you have to do is, in case the portfolio falls, so your portfolio, let's say it falls from 5 crore to 4.5 crore. So earlier you were withdrawing, say 4%. Now, if you adjust it to inflation, because your portfolio is smaller, you might be withdrawing 5.5 or 6% from your portfolio. So if that is the case, you have to cap your withdrawals at 5%, right? And on the other side, if the markets rise, your portfolio of say 5 crore becomes 6 crore, right? So suddenly whatever you are withdrawing becomes a much smaller percentage of the overall portfolio. So even if you are withdrawing say about 4%, but this year because of the boom in markets, because of your bigger portfolio, it's just three less than 3%. So in case it is less than 3%, you can actually spend more and reset that spending or expenses to 3%. So that's what you have got to do. In case your overall expenses are above 5% or below 3%, you can tag it to those upper or lower band. In case you are doing this, there are huge advantages. What are the advantages if you're doing this? Let's look at this, right? So in case of inflation forgo, now here the whatever these research has been done, this was done at a baseline of 3.2%. So your effective safe withdrawal rate in the base case is assumed to be 3.2%, which means your target corpus requirement is about 31x. If you're using the inflation forgo method, right, your actually your uh, safe withdrawal rate actually increases to about 4.5%, which makes your corpus requirement to just about 22x. And if you're using guardrails, now this was really surprising because the change from in safe withdrawal rate is huge. In case of guardrails method, your change actually is up to 7% you can withdraw, which means you just need to have about 14x of your annual expenses. Now, this to me, frankly, is looking slightly on the aggressive side, but I am pretty happy that if you are using one of these, at least from 3%, you're able to reach somewhere between 4 to 5% of withdrawals, which means that you need much lesser to retire than if you were to use fixed withdrawal method only, right? But these things obviously does come with a cost. There's some cost attached. There's some downside if you're using these dynamic withdrawal methods. One is obviously because it is dynamic, you are left at the mercy of the markets. That if the markets are down for a couple of years, if which does not happen very frequently, it's very rare. But if it does happen, then in that case, you have to definitely keep on reducing your expenses, right? But that is required also because if you have to last your corpus for longer, otherwise you're going to run out of your corpus, right? And secondly, where it helps is it reduces the extreme portfolio depletion risk. That's what we are talking about, and it smoothens out the overall tail outcomes. So you can actually in good times you are able to withdraw more and enjoy those good times, but in the bad times you have to cut down. So this is, I think, the only risk here is that you have to be slightly dependent on the markets, and your lifestyle is also dependent on the markets. So that's the one big maybe downside. But if you think about these downsides, historically, what's the probability of having a down year in India? I think the probability would be less than 20% or so, right? So out of every 5 years, 1 year you have a down market, and in that 1 year, you have to reduce your spendings a bit, right? So that's the only risk. So One out of every 5 years is pretty good number, I guess. That if you were to ask me that your requirement is reducing, if you were to follow this dynamic withdrawal rate, once in every 5 years, you have to maybe curtail your spending. But you can maybe using this dynamic withdrawal rate, um, you might be able to retire at a slightly earlier couple of years. I think it's a uh, pretty good deal, really. Right. Now, one of the questions that we also get quite frequently is people ask that till now we are suggesting maybe about 50-60% in equities. So if what if somebody has a higher risk appetite? If they can afford to invest much higher in equities, even after retirement, let's say 70, 80, 90% in equities. Uh, so it's very intuitive that obviously if you are investing higher in equities, your growth in the portfolio is going to be higher, and then you can have a high safe withdrawal rates. uh, does it really make sense? Now let's look at the data, but before data, we'll also talk about the role of equity in growth and risk. So obviously equity is required for higher growth in your portfolio, which enables higher withdrawal rates. Equity is a growth driver, but also it comes at a risk. There is higher volatility after your retirement, and maybe before retirement you have a high risk appetite. But after retirement you really become very anxious if your portfolio is depleting for a couple of years, and obviously that comes with a higher risk of failure as well, right? So this specific data is what I was talking about. This is the original study, and original study by Benjamin in 1994. So if you, what he has done is, on the y-axis we have the minimum years withdrawals will last. So if you are just withdrawing maybe 1, 2, 3%, then that specific number, then higher equity definitely helps you. So you have these five bars, which is one starting with 0% stocks, 25%, 50, 75, and 100%. So for each withdrawal rate, you have taken these five cases with five different allocation to equity levels. So obviously you'll be considering somewhere between 3 to 5%. So let's just pick the 4% rule. If you look at this 4% number here and these five bars, what it shows you is it has the highest, the minimum years that your portfolio is going to last is the highest in case your stocks are 50%. The allocation to stocks is 50%. If it is 75%, then it is becomes slightly lower. So the minimum number of years your withdrawals will last is going to be slightly lower. If it is 100%, then it is maybe about 20 years or slightly about 20 years. So in case of 4% and 50% stocks, 4% withdrawal and 50% stocks, your number of years where your retirement is going to last, that number is the highest in case of 50% stocks. And it is taking us back to that uh, sequence of return risk. Because of the sequence of return risk, the higher stocks you have in your portfolio, the higher are the chances that your portfolio is going to deplete in case you're having bear markets in the earlier years. So it's not only about first year. In the first 5 years, in the first 10 years, if you have those kind of bear markets, that is going to really impact your overall time your portfolio is going to last. So the optimum equity allocation is around 50%. You can make it slightly higher if you have higher risk appetite, or you can make it slightly lower. But it's somewhere in the range of 40 to 60% in case of retirement. In case of the optimum equity allocation after your retirement, right? So finally, summing it all up, we learned about the safe withdrawal rate. So if you have a corpus in mind that this is where you're going to reach and you're retiring, what is it that you can withdraw? You can withdraw maybe about 3.5%, but not 4 or higher. In case you're using the fixed withdrawals. or the corpus size target, your current, what you're doing is take your current annual expenses. If you are retiring 10 years from now, inflated by inflation number 6%, let's say, and whatever number you get, you take 33 times, which leads to about 3.5% of annual withdrawals. And that is 33 times of your annual expenses is what you need. The optimum asset allocation is have about 50% in equity, rest majority in debt, and maybe about 5 to 10% for stability of your portfolio in gold. In case you are okay in using using the dynamic withdrawal method, in that case, you can go ahead with maybe even 4% safe withdrawal rate instead of closer to 3%. Meaning instead of 33 times your annual spending, your portfolio requirement is about 25 times uh, of your annual spending. And finally, while in retirement, you have to review every couple of years, you have to review your plan and make adjustments according to the equity markets and how your portfolio is doing. Right? So, yeah, that's about it from our side. Happy to take questions here.
Thanks, Vivek. That was a wonderful session. We have gotten several questions. I'll begin asking them to you one at a time. But before we jump to that, I just want to let everybody know that the recording of this session would be available on Gulaq's YouTube channel, and we would be sharing with you the presentation and the spreadsheet as well that Vivek has just shown you. All right. So coming to the question, Vivek, one of the most important question that came to my mind was the sequence of return risk. So you spoke about how dangerous the sequence of return risk is. So it can create a massive dent in your portfolio if you're experiencing negative returns early in your retirement years. But what are we supposed to do? Like, what if I consider myself exceptionally unlucky? So I consider myself as one of the person who would retire at a period of 2008 financial crisis or dot-com bubble. So if I am one of those unlucky folks, what are we supposed to do? We can't stop living. We still have to pay rent. We still have to pay bills. So what is the hedge against that?
See, this specific whatever numbers we have spoken about, I think this takes into account your kind of people, which means unlucky people, right? This does take into account, and that's why the probability of success in this is very high. Really, in this, actually, you can, I feel you can maybe have slightly lower corpus if you are okay with having uh, less probability of being right. So in this case, he was being super conservative. This financial advisor Benjamin, who came up with that 4% rule also. I think in 2015 or so, he again gave an interview in which he said that as of now, earlier in his earlier studies, he was super conservative, and as of now, he is suggesting to his clients that they can withdraw even 5% from their overall corpus. So I think 4% rule, or in India's case, it's maybe slightly lower, 3.5% or so. It takes into account kind of the extremely bad cases that you are talking about, right? So it's these numbers are super conservative in nature, and in all probability, what's going to happen if you were to follow these safe withdrawal rates, your your corpus at the end of 30 years is still going to be pretty large. Actually, in most of the cases you have a maybe 40-50% chance that you're going to have a super big retirement kitty even at the end of your retirement time of say about 30 years. So these all are, I think, very conservative numbers if you were to follow this. Again, we can't say with 100% probability that, but there is a very good probability that these numbers are going to last for 30 years or even longer, really. So yeah, these numbers are super conservative. That's what I have to say.
So this is one end of the thread. Let me take you to the opposite end. So one biggest risk is obviously what if we run out of the money? But
Yeah.
another end of the spectrum is what if we don't spend as much as we could have? So that opportunity cost. So do you see that as well a risk? Because I was reading one report where it was discussing that a lot of US retirees, people in America, they were not actually spending as much as possible. You also spoke about that interview that Benjamin gave. He mentioned this fact as well, I think, where he was
Yeah.
speaking that people are actually not spending as much as they could. So, do you
I
see
think
that as a risk as well?
I think it's more psychological. That is definitely a big risk for those who have done their retirement planning well. It is only a risk if you have done your retirement planning well. If you haven't done your retirement planning well, that obviously that is not a risk. But if you have done it well, and because see what happens, I think is obviously I am not in that stage, but from what I have read, from what I have, when I speak to people in both stages when they are earning and saving for retirement, and also I do keep talking to a lot of people who have retired and are at a retirement phase. I think the change is very big and psychological in the sense that when you are saving, when you are earning and saving, uh, you obviously you are in a very different mindset, right? You are not withdrawing and you are very habitual ki every month, or not every month, but at least every year you are seeing your portfolio grow. Even if the markets have taken it down, you are putting in money every year. So it becomes a really very good habit to see your portfolio grow over the years. And towards the end, obviously, when compounding kicks in, you're seeing your portfolio grow by leaps and bounds in terms of INR value. So I think it becomes very, very big psychological change in your mindset to actually stop seeing it grow and you start withdrawing from it. It is a very big mental block, and people are actually unable to withdraw and really they are unable to use that retirement kitty well, which you pointed out. I think that's certainly a big risk. I see that many people who have done retirement planning well, they leave a lot on the table. They are unable to enjoy the proceeds, unable to enjoy whatever sacrifices they might have done during their earning phase to save for retirement. So this definitely does happen. I think there's no hard and fast rule. I think every couple of years you definitely have to sit and assess where you are, what stage you are in, even if you're when you're retired, how the markets are treating you and whether you are withdrawing those money well or not. I think it becomes very critical in this case. I've seen people work with financial advisors and that really helps them. Otherwise, they are always too anxious about withdrawing money. So it really helps whether it's a fixed fee planner or whichever way, but a good financial planner, a financial advisor can really help you with that psychological aspect of withdrawing money also because you got to enjoy your money, obviously. You don't want to leave too much on the table. You don't want to do all those sacrifices even in your golden years. But that does happen a lot, and this has been proven by research also that a lot of retirees, what they withdraw is just whatever their portfolio has made, and they don't really withdraw anywhere close to 3-4% numbers that we are talking about.
There are big group of people who want to leave some sort of inheritance to their children as well. So, do you think people should mingle the retirement corpus and that inheritance money that they wish to pass on to their kids together, or do you think it should be separate?
Sorry, can you repeat your question? Your voice was breaking a bit. I couldn't hear it clearly.
I was asking if people want to pass on some of the money that they have accumulated all their lives to their kids, to their children. Do you think people should mingle that fund, that corpus as well with retirement corpus, or do you think there should be a separation between the two?
See, my view is there should be not really separation. The priority has to be your retirement, whatever expenses you are having in retirement. It should not come at the cost of that you want to leave something for the future generation. Obviously, if you leave, obviously you'll feel good, but it should not really come at the cost of your retirement life, really. That's what I think, and that's why I feel it should be kept uh, same. There shouldn't be any separate money for that, because otherwise your retirement really comes. What we know is most of the people even struggle to save what is really required, right? So if you keep something aside separately for your future generation, it becomes all the more difficult for you in the retirement stage. So I think you should keep it safe. If the markets treat you well, then obviously there's a very good chance that you're going to leave a decent corpus for your future generations also. But I don't think we should really plan for it separately. The priority should be given to your retirement corpus, retirement kitty.
On that subject, people sometimes use their retirement corpus as one piggy bank and fund every expense from that. So even their children's education or further some marriage expense or any other expense also, that also comes out of this retirement kitty. So do you think people should goal plan more prudently and separate all these goals and save separately for
Yeah,
them,
yeah.
or is
No, no, definitely. See, save separately means whatever numbers we have spoken about here. This is purely for your retirement. It does not include your kids' education, your kids' marriage, or maybe any other goal that you might have, right? So this is purely for your retirement. If you were to save, let's say, a separate, if you need to really account for your kids' education, your kids' marriage, or any other big goal that you might have, then obviously you have to save on top of this, right? In excess of this. Now, whether you have separate portfolios for these goals or you have one portfolio, I don't think that's a very big, um, uh, really very big factor. It's totally up to you, whatever you like. I personally like to keep all my portfolio uh, at at one place, but obviously, you have to save in excess of these numbers that we have spoken about in case you have any other goals.
that makes sense? And I know you spoke a little about this during the webinar, but this is a very important point, so I want to stress on this again. People sometimes confuse how 4% rule actually works. So a lot of people, including myself, when I first learned about this concept, I assumed that, okay, 4% rule, which means I just deduct 4% out of my total corpus every single year and I'm set. So if you could throw more light on that, how exactly it works, that would be great.
Yeah, definitely. I think this is definitely, I see many people are really confused by this specific 4% or 3% rule. What this says is, first of all, you got to have about maybe 50 to 60% in equity. It's not going to really work if you have just about 10-20% equity. So a decent equity level is what you should have. Secondly, this is meant for roughly about 30 years of your retirement life. If you are planning to retire much earlier, let's say at 40 instead of 60, 40 or 45, then obviously you got to add maybe 10-15 years to this retirement. You need your money to last for about 45 years. Now, this money can last, but the probability of this lasting really goes down if you plan to use your money for beyond 30 years, if it is 40-45 years. So that is second. And thirdly, the most important point, I think, where the confusion comes in is about this 4% rule. What you were stating is, in the first year, you withdraw that 4%. So if your portfolio is retirement portfolio is 1 crore, then you withdraw 4%, which is 4 lakhs, use it for expenses, and then every subsequent year you see what the inflation was last year. So if the inflation, let's say last year was 6%, then you withdraw 4 lakhs plus 6% of 4 lakhs next year. So 6% of 4 lakhs is 24,000. So the next year you would withdraw 4.24 lakhs, and so on and so forth. Even the year after that, you will inflate it again by 6%, let's say. And that's what it is. It is not, I think many people assume that 4% means whatever your portfolio is, every year you keep withdrawing 4%. That's not what the rule states. Right. So every year you have to inflate it by whatever the inflation number is and withdraw that amount.
That makes sense. Some people are confusing the safe withdrawal rate that we have discussed in the session with the systematic withdrawal plan that is seen in the mutual fund. So, if you
Yeah.
could contrast the two terms.
Yeah, so systematic withdrawal plan is obviously it is about withdrawals, whatever you want to withdraw. So, like the SIP, when you are saving, you can save via SIP. So every month you invest whatever 10,000, 20,000, 50,000 systematically in your portfolio. Now, SWP is totally opposite of that. People use it during retirement. So you have a portfolio and you withdraw from a specific scheme, let's say that you have already invested in. You want to withdraw 1 lakh every month from it. So you put in a mandate of SWP wherein you get um, whatever amount, let's say 1 lakh it is, you get 1 lakh. The mutual fund manager will sell that much units and redeem the money back to you. That is the the systematic withdrawal plan. And here we are talking about what amount you can withdraw from your retirement kitty. So if your retirement kitty, again coming to the example of 1 crore, if you're retired at the time of your retirement, if you have 1 crore, the maximum that you can withdraw is depending on whether you are using that fixed withdrawals or dynamic withdrawals. But let's say you're using dynamic withdrawals and your number you feel you can withdraw, say 4% or 4.5%. So you can withdraw that much amount in the first year from your retirement corpus. So those two are essentially same, but SWP is used primarily during the retirement phase actually.
We have gotten quite a lot of questions around asset allocation. People are asking, does a static 50-50 asset allocation or 60-40 allocation throughout the years? So if I'm 30
No, I
years
think,
old,
yeah. Yeah, one thing we missed out on is that in this, the another assumption that we missed out is that you got to rebalance your portfolio every year. So whatever portfolio you are having, you can have obviously some leeway, some buffer, but you have got to rebalance your portfolio every year to, let's say you started with 50-50 and you want to track that 50-50. So every year you rebalance your portfolio to 50-50. So that is one thing that you need to do in your retirement phase.
and do you think the debt equity allocation should change throughout the years as we are aging, or can we assume a static debt equity allocation and just follow that throughout the years?
I haven't really given it a very strong thought because in the end, towards your retirement, towards the end of your retirement phase, what usually happens is your expenses reduce drastically, right? Obviously, your some of the medical bills are going to go up, but overall, from the research, what has been shown is uh, your expenses are going to come down a lot. Your expenses on your going out, eating out, on your clothes, all most of these kind of expenses actually does come down in the later parts of your retirement. So if that is indeed the case, then I think if again it will depend a lot on you that if you are the kind of person who would want to leave a decent part to your future generations. In that case, obviously you would want to keep equity slightly higher, so maybe keep same, but you're going to see some volatility in your portfolio. But if you really that is not your view, then in that case, maybe towards the end, you can keep reducing your equity part just so that the volatility in your portfolio keeps coming down. So that is something you can do if you feel that in the initial few years equity has given very good returns and your expenses has also started reducing. Maybe you can uh, reduce your equity exposure a bit towards the end.
There is slight bit of confusion amongst audience regarding the asset rebalancing that you spoke about. Could you give a simple example around that?
Hmm. So the simple example would be, let's say again, 1 crore of portfolio. you have 50 lakhs in equity and 50 lakhs in debt, right? Um, and you wish to withdraw 4 lakhs from it, right? So you withdraw 4 lakhs from it. At the end of the year, what you have to do is, it totally depends on equity returns and debt returns. So let's say at the equity, initially you have withdrawn 4 lakhs and after that you have 50-50. Now let's say we assume 10% growth in equity, or let's take a slightly extreme example of 20% growth in equity, right? So this 50 lakh is going to become 60 lakhs in equity, right? And you have, say, 7% growth in the debt part, which is 53.5, right? So your portfolio becomes 60 lakhs in equity and 53.5 in debt, right? So what you've got to do is, your total portfolio is about 113 lakhs, right? So you withdraw 4.24 lakhs from this, which means your inflation adjusted 4.2 lakhs you have withdrawn. So your portfolio becomes 109 lakhs. And from this 109 lakhs, now it has to be divided in a way that about 54.5 lakhs is in equity and 54.5 lakhs is in debt, which means you got to do uh, some selling from equity part and move that to the debt part.
That makes sense. Uh, one user is also asking how do we factor in taxes, LTCG, STCG, etc. into this rebalancing? I think that's a big one, Vivek.
Yeah, that's a big one. I think what we are trying to do, because it depends a lot on when you have done those investments. Um, Primarily whether it's long term, short term, mostly it's going to be long term. But what we are trying to do right now is, uh, we have developed an app, a Gulaq app, primarily for mutual fund investors. But in that specific app, we are going to uh, actually build these kind of decisions only, that if you want to withdraw, you have a 1 crore worth of portfolio, you want to withdraw, how do you withdraw it in the most tax efficient manner, right? In the most efficient has to be based on your exit loads, based on your taxes, and based on the performance. So let's say if one of the fund is not really expected to perform well and you have to anyways exit that fund, you might as well just withdraw from that specific fund. So I think it's not a very straightforward answer, but the state even the way you calculate from where you withdraw is also not that straightforward. You'll need definitely some help, and that is what we are trying to build in Gulaq right now. Obviously, all of this is not built, but that's the vision. In next couple of quarters, you're going to see all of these and more features in the Gulaq app. Yeah.
For sure. We are running out of time, so we'll just take one last question. Uh, Anant is interested in knowing in terms of debt allocation, how do you suggest bifurcating this debt investments into different categories? We have seen, liquid funds, we have short-term funds, overnight funds. There's so many different debt allocation category. Where do you invest your debt funds?
Okay, I think these are two separate questions, because if you're asking me where do I invest, as of now, I'm not investing too much in debt. I have very small allocation. I think it would be less than 5% really, um, in debt, right? The way I think I see real estate as a proxy to debt. So that's why a decent part of my portfolio, which were to go into debt, is in real estate, because it gives you a decent yield. In cities that are growing, it gives you good growth as well. So the yield is there, the growth is there, and obviously the stability is there, and the yield obviously grows with inflation. So I think in my mind, real estate is a proxy to debt, uh, and slightly better. Obviously, you're taking higher risk than debt in real estate, but it gives you slightly higher returns also. So as of now, because I'm in the investment phase, I'm relying more on real estate. And I think even towards the in my retirement, I'm going to use fair bit of real estate in my overall portfolio just because of these. Obviously, there is some overheads in real estate in terms of the management of that property. If you're obviously rented it out, how do you manage? All of that is there, and that's why I haven't personally invested yet in REITs, but that could be a pretty good alternate to having a physical real estate, because REITs lets you invest primarily in commercial real estate where the yield is almost double that of residential real estate. The yield there would be about maybe somewhere between 5 to 6%, and obviously you get some growth in terms of your appreciation of those properties as well. So, firstly, I am not investing too much in debt. I am more keen towards investing in the real estate side, and also REITs is something I plan to shift to REITs going ahead. Um, yeah. In terms of, I think this the question was also uh, your retirement corpus at the time of retirement, when you are in that retirement phase, where do you invest that debt part? I think some part obviously for 2 to 3 year next 2 to 3 year, those kind of expenses has to be in more liquid and short-term debt, which is in terms of debt, which is the most safest and safest also in terms of its sensitivity to interest rates. Because debt also, many people don't know, debt can give you some losses also, right? Although those losses would not be as high as that of equity, but depending on where you have invested, if it is more a longer term debt, right, that bond prices are sensitive to those interest rates also. So if the interest rates suddenly rise or fall, that can impact a lot on your debt portfolio. So I think at least 2 to 3 years kind of expenses you should have in those short-term debt securities, which is primarily more liquids and overnights or even arbitrage fund, which does not uh, really move too much with interest rates. So 2 to 3 years have there, and rest I think more in a slightly more diversified kind of portfolio. I think there also slightly the role of advisor would come in as to where to invest depending on where you are at the interest rate cycle. If you are closer to peak, and these interest rate cycles are obviously very, very long, but if you are closer to peak and you are expecting interest rates to come down, then how to invest, versus if you are maybe closer to bottom and you are expecting interest rates to go up, then exactly which kind of debt instruments you should be invested in.
We have gotten one more question. A user is asking about ST's iAlpha product, which is a market neutral product.
Yeah.
They are interested in knowing whether this can be treated as a proxy for debt investments in the retirement phase.
Yeah, definitely. I think this is something that a lot of retirees use. A lot of retirees have invested in our company, which ST's iAlpha PMS. So what we are doing is it's essentially a arbitrage. It is a pure arbitrage product in which we are able to deliver. Historically, we have delivered about 12 to 13% gross numbers. Obviously, tax and fees comes out of it, but even after that, uh, you're able to get more than FD, about 2 to 3% more than FD in iAlpha. There are some advantages apart from the returns. That is the liquidity. So you have monthly liquidity here. So you can withdraw that you can't do in FD, but you can withdraw in a month's time from iAlpha. And secondly, it has a unique track record, 17 plus years, not even a single negative month. Every single month in last 17 years have been a profitable month in iAlpha. And as I said, a lot of retirees do use this product as well. They have put it in the monthly redemption mode. So whatever money they get, let's say 1 year, they have put in 1 crore in this. And if the gross returns are 12%, they put in a redemption mode. So every month they can withdraw 1 lakh from that specific fund. So that's an example. Obviously, returns do vary, but not much. Broadly, the gross returns are of the order of you can expect it between 11 to 13% in that range. And it's quite a popular product amongst retirees, yes. But obviously, since it is a PMS, the minimum investment size in this becomes 50 lakhs.
And if anyone is interested in exploring whether whether any of the ST Advisors products would be uh, suitable for you, you can visit pms.stadvisors.com and leave your contact details there. One of our team members will make sure to contact you back. With that, Vivek, we are at the end of the session. Thank you so much for the wonderful session.
Thank you, Akit, and thanks everyone for attending this specific session. I hope this was useful for you guys. And do let us know. I think we are going to maybe send you a feedback form. Please do let us know your feedback, not only for this session, but if there's any other topic, any other investment related topic that you would want to know about, would want our views, we'd definitely love to hear from you. So please do leave feedback for us.
Absolutely. Thank you, everyone. It was wonderful having you. And once again,
Thank you,
the
everyone.
recording of this webinar we will be sharing with you over the email as well as on your WhatsApp. And you can always revisit any section that you want to revisit. Thanks, Vivek. Thanks, everyone.
Thank you.